basically, what I've come to understand in regards to supply and demand. Can you see my screen?
The one written understanding supply and demand.
Yeah.
Yeah.
Okay, that's good. Right. I've come to understand that as retail traders, we are always lured to trade in the wrong direction most of the time. Even if your direction is correct, it's either you are stopped out or your stop loss gets hit first before the market moves in your correct direction. So what I've come to understand in my couple of years in trading is that the institutions, I mean like the banks, the hedge funds, the big players of the market.
Yeah, the firms, yeah.
Yeah. These guys, they've got certain levels that they trade from. What I mean is we've got different brokers in the world. We've got different institutions. So every broker doesn't have the same price on an asset. So for example, say JP Markets gold price is 1340. Then you go to FX Pro, you're gonna see maybe it's like 1341. You see, there's like a difference. Yeah, there's a difference in the pricing with every broker. But now when it comes to the institutional pricing, there's like levels that they trade from.
Okay.
Yeah, they just don't trade randomly from any certain level. They've got levels that they trade from. For example, you look at like the whole numbers. Let's say on gold, if gold is at 1300 level, if it moves to the 1400 level, those are two whole numbers. You see, they will trade probably from those two levels.
Yeah.
Right. But now it's not just a case of taking note of the level. There's also the way price moves from those levels that will determine whether it's a strong supply or it's a weak supply, whether it's a strong demand or it's a weak demand.
So is it determined by the institutional traders?
Yeah, institutional traders. Okay. You're gonna see once I'm illustrating with charts, you're going to see like exactly what I've just spoken about.
Oh, okay.
Yeah. So basically, the supply and demand concept is a core component of the economic theory. The supply and demand rule states that if the supply of a commodity is high and the demand is low, this will generate excess, which drives the price down. You see, if there's more demand, if demand is low and the supply is high, it means that asset is gonna be cheap, right? And conversely, if the supply of a commodity is low and the demand is high, it creates scarcity, pushing the price higher. It means something which is scarce, it becomes expensive. You see, that's the basic.
Yeah, that's true.
The basic concept of supply and demand. The same applies when it comes to Forex. You see. So the supply and demand rule is pretty easy to understand, and it could be applied to anything which falls in the group of tradable resources. So you can apply supply and demand to any asset that you are going to be trading, whether it's a commodity, it's Forex, or it's maybe gold, silver, those are the commodities, or it's stocks, index, So you can apply the same concept to those assets.
It's an economic rule.
Yeah.
Okay,
yeah. But now for us, we're going to be using it in the Forex market. Mainly, we're going to be trading currencies and commodities such as gold, silver, oil. You see, indices, they're a bit difficult to trade with supply and demand because there's not a supply of anything on an index. You see, it's like a measurement of maybe currencies, of stocks. So trading indices with supply and demand doesn't really work well. You see. So for us, we're going to be applying the supply and demand concept in the Forex market. So if the supply for a currency pair is high and the demand is low, it will drive the price lower. If the supply for a currency pair is low and the demand is high, this will act to drive the prices higher.
Yeah.
That's the basic part of it. The supply and demand of a currency pair is determined by the players in the Forex market. And these are the governments, the banks, the investors, the funds, and the speculators, which is us, the retail traders, the small boys. So through the actions of these people that I've mentioned, these institutions in the market, you see, the participants, the participants in the Forex market are constantly shifting the supply and the demand of the currency pairs, causing the price to fluctuate. For example, if you open a currency trade, you are taking part in the supply and demand equation within the market. So whenever you open a trade, you are also taking part in the supply and demand of a pair. You'll be taking part in the market. Yeah. Right. Let me go to the next. So now it comes down to the question like, what are supply and demand zones in Forex, right? Because that will be the logical next question a person has to ask, like how then do you
determine
the demand zone or the supply zones? You see? So supply and demand imbalances in Forex can be seen visually on the price chart. Each candle on the graph represents changes in the trader's attitude towards the respective pair. You see, when we are trading, retail traders, institutional traders, each candle represents changes in the attitude of the traders, like the mentality of the traders. It will tell us whether we are bullish or we are bearish, right? Yeah. That's if the traders have a certain bias on a currency pair at a certain zone. This can be recognized on the Forex chart by an informed trader, right? In other words, what I'm saying here is most people, especially retail traders who trade support and resistance. You see, there's a difference. Support and resistance and supply and demand. There's a slight difference which most people tend not to recognize. So retail traders who trade support and resistance, each time price comes back to a certain support area, they look to buy. You see? Each time it approaches a certain resistance area, they look to sell. But now, for someone who's well informed, the moment price reaches those areas, that's when you're supposed to be looking for institutional supply or institutional demand. That's when you're supposed to be looking for the signs to say, okay, is there any buying that's happening on this asset from the big guys' side? Or is there any selling that is happening on this asset from the big guys' perspective? So that's when an informed trader jumps in with a clear mindset. It's not just a case of saying, oh, head and shoulders, we are back at the shoulder. No, that's not the proper way to do it. Yeah, that's why most people lose. So, for example, if the currency pair is moving downwards on selling pressure, right? Some traders will position pending buy orders at certain levels below the price. Huge momentum of price going to the downside. Most people, they'll place pending orders, as in pending buy orders. They're expecting the market to bounce to the upside. These people do not believe that the pair will go much lower beyond their buy limit order. They place buy orders at this level to purchase the pair on the assumption that the bearish move is likely to stall, as in they expect price to bounce, right, from the support area. That's why they are placing their buy orders, right? So now, what happens now in the Forex market? If a large group of people do this, or even if a large institution does the same thing, there will be an accumulation of huge volume of pending orders at that zone, right? Can you hear me, Cosmos?
Yep.
Yeah. So the moment there's a huge concentration of buy orders, right, at a specific zone, this means the demand is going to increase, right, as price reaches that level, because more people are going to place, more people will be placing their buy orders at that level. That means the demand is going to increase, which is likely to cause a sharp increase as price approaches that level. So the moment price hits that level, price is going to rally up in a sharp move from that level, which had a lot of pending buy orders. Price is going to react, and it just doesn't react in a small move. It reacts in a huge move to the upside. You see?
All right.
Yeah. So the same can be applied when, say, market is running to the upside. Most people, they are going to place their
On the bearish.
Most people, they will place their sell orders at a specific zone, right? And the more they do that, you see, the sell orders are getting accumulated, and there's going to be a lot of supply in the market, which when price reaches that level, price is going to drop sharply upon reaching that supply zone. So say market is rallying to the upside, say gold is on its way to 1450, right? The moment,
Yes.
the moment everyone sees that, okay, 1450 price always bounces to the downside, so everyone puts sell orders there at that level. So the more those sell orders accumulate, there's more volume. You see? So when price reaches there, it's gonna react. It's gonna drop sharply from that 1450 zone. Right? That's like the basics now of how accumulation helps in identifying institutional selling or institutional buying. So the way the market reacts, let's say buy orders have been triggered and markets rallied all the way to the upside. That's not retail traders that are moving that price. It's the institution.
Yeah.
Because they've seen that there's money there.
Oh, yeah. Was that? Okay, yeah.
Because the institutions, they've got access to some of the information that we don't have, like volumes, to see, okay, a lot of people, they want to buy this asset at this price. Okay, let's entice them to what? To buy at that level before we go
to that level.
Yeah, to the other side. You see?
Okay.
Yeah.
Okay.
So the thing that you need to be aware of is these two important levels within the charts, the supply and the demand, where prices are likely to rise and fall. The demand zone, price is likely to rise. The supply zone, price is likely to fall. Right? So that's like the basics.
Yes.
The basics of supply and demand. So now let's take a closer look on a demand zone, right? So a demand zone is a price area below the current price action where there's strong buying interest. Remember, where most people are going to put their buy orders. That's where demand is.
Yes.
If you look on this chart here, you can see I've highlighted level 1, level 2, level
just below.
Yeah. And level 4. Just below those levels, right? Let's start with 1. Can you see how price reacted at 1? Can you see how price reacted? This is the H4 time frame.
Yeah, it quickly went up after.
Yeah. It rallied to the upside. Now, you don't have to focus on everything which is happening when price is rallying to the upside. What you need to focus on now is the reaction that the market is going to have when it comes back to the same area, right?
Okay. Yeah.
Market rallied on level 1. It rallied all the way to the upside, and then it came back. But now if you look, when price came back on this bearish candle here, the red one, it took out the low of that first candle that rallied all the way. It took out its low, and then market went all the way up. Now look at number 2. When market came back to the same zone, it didn't even touch any of those lows, but it reacted, right? The market reacted.
They had rallied up again.
Yeah. Now, in that moment when it's rallying up, remember, people would have placed their buy orders, right? But
Yes.
but those buy orders, most of them, they were not triggered. Market didn't trigger those buy orders because people will be trading at this demand. Most people will be
Level.
most people are going to be looking at this demand, right? But now look at the third time when market comes back. It spikes into that supply. It triggers the buy orders, and then it went all the way up. You see, this is a 4-hour candle. That's a lot of good. Yeah. So mostly the second test of a demand or a supply area is not a good entry point. But the third, you have to look, once we go further, there's certain aspects of the way price moves that I'll be showing you that will give you a clear picture to say, okay, no, this demand area is going to hold, or this demand area is not going to hold. You see? So once we are further into the course, you'll be understanding now. Because look at even level number 4. What happened on level number 4? Price spiked into the demand again and rallied all the way to the upside. Now, if you look at candle number 4, you see that candle at number 4. At one point,
the one which went into the
sorry.
the one which went into the demand zone then.
Yeah. Can you see number 4?
I mean the one which went into the zone.
Yes. Number 4. That candle at one point during the price action, when price was rallying to the downside, that candle at one point was a big, solid, bearish candle, right?
Yes.
Yeah. Now imagine you are seeing a big bearish candle to the downside. Are you gonna buy that asset? Most retail
you would think of a sell,
most retail traders, they'll be like, no, market is going all the way to the downside, right? But now
they'll go straight.
They'll short. The way the price reacts now, you see, it's a 4-hour candle. You have to wait for that candle to close. The moment you would have seen that, okay, price spiked into demand and closed with almost, I don't know if this is a doji or something, then this would have been a clear indication to say, no, prices is going to rally all the way to the upside because it has triggered already people's orders here, and then it rallied to the upside.
The upside.
Yeah. So yeah, it's quite of it's not that difficult to understand, you see, but it's a case of knowing what to look for.
Yeah, I've been in the WhatsApp group,
Yeah, it's a case of knowing what to look for. Oh yeah, you were in the WhatsApp group. I forgot. Sorry. So it's a case of knowing what.
So yeah, a bit of knowledge.
Yeah, it's a case of knowing what to look for when price is reaching a supply zone or a demand zone. Right. So this is just the basics. Now we're gonna look at from a supply zone's perspective. So the supply zone is the exact opposite, right, of the demand zone. A supply area is located above the price action, and it typically contains a relatively big volume of sell orders, right? When price action reaches this zone, the orders starts to get executed, traders will be selling their assets and price action reverses to the downside. As with demand, the supply zone refers to an area, not a single level. That's one of the difference between supply and demand and support and resistance. That's one of the difference. Support and resistance refers to a single level.
Support this supply. Yeah.
Yeah. Supply and demand refers to a zone, not just a single price level. You see. So now you can see on this weekly chart of USD.
Yes.
Yeah. You can clearly see the supply area there. Market returned to that. Can you see? Where's my highlighter? Let me get my.
Yeah, I've zoomed in.
Right. You see this area, this candle here, the one that I've highlighted.
Yeah.
Yeah. You see how it reacted.
To show you the one.
Yeah, this guy here.
Yeah, I see the bearish one.
Yeah. That's a huge move for a weekly candle. And it's like it never looked back, right? So market kept on tumbling, right? Now, when market reversed to the same area, look at this bullish candle and then this bearish candle, right? You can clearly see that the bearish candle reacted to the wick. It took out the wick of the last week's high and then market tumbled. So you as an informed trader, you'd have already noticed that, okay, we are back now on a supply zone, right? So what are we looking for? We are looking for short trades. There's no way you're gonna, there's no way you're gonna be looking for buy trades when market comes back to that same area. There's no way when market comes back here. So prior to this huge move to the upside, you'd have already triggered to say, okay, no, shorts now are ideal on USD CAD. There's no way we're gonna be looking for long entries. It's just shorts. So when market tumbles like this, remember this is a weekly chart. There's a lot of opportunities in this chart to take the market to the downside. You see?
Yes.
Yeah. So, sorry. So it's just a case of highlighting your levels. Know which levels that you are going to be trading from. You see? Then you stick to you stick to that principle. Of course, there's going to be losses. You see, there's going to be times when you're going to be wrong or the market takes you out. But the more you stick to the same concept, 8, 9 out of 10, you're going to be correct because you are knowing what exactly you are looking for on the price chart. You'll be knowing exactly what you are looking for. Let me highlight this.
Yeah, that's true.
Yeah, you see, because the most problem that retail traders have got is we touch a lot of assets. You find one person on MT4, he's got like 12, 15 charts open. You see, that messes up your brain.
Pairs, yeah.
You see, so it's just a case of having like 4 pairs on your portfolio, or even 3. Like me, I've got 3 assets that I trade. If you have noticed, Euro USD, gold, and dollar index. Those are my main pairs. Of course, I link them with the other pairs now, like AUDSD, NZUSD, because of correlation. You see, it's something that I've already understood. Yeah. Right.
You showed us that. Okay.
As I noted earlier, when price action reaches a supply or a demand zone, it is likely to reverse its direction. Therefore, these zones are used by price action traders to enter the market in the respective direction. If the price action decreases to a demand zone and bounces up, this creates an opportunity to trade the currency pair upwards. When the price jumps to a supply area and bounces downwards, this creates an opportunity to trade the market in a bearish direction. That's just a summary of what I have shown you.
All right.
Yeah, it's just a summary. So now What do we got next now? Right. So now, how then do we draw supply and demand? So it's always a good idea to draw supply and demand zones on the chart. This way you will be aware visually of where the zones are and be prepared to trade the market price between the appropriate supply and demand. So it's just for you to have triggers ready to say, okay, no, this week I'm going to be looking at this price zone. If market comes to that zone, that's when you look to enter the trade. If it doesn't, then fine, fair and square. I'm not going to enter the market. You see? So now you'll be asking yourself, how then do I find supply and demand areas on a chart? You see?
Yes.
Yeah, that is fairly straightforward. First, you have to zoom out of your trading time frame chart and switch to the next higher time frame. Normally, you just have to start from a higher time frame. You see? Say from a monthly chart, weekly chart. Mostly, we start from a weekly chart because weekly price always holds up. Or if weekly momentum is bullish or is bearish, it always holds up at the end of the week. You see, it always comes.
Okay.
Yeah. You see, price always comes to the. I'm gonna show you now on the chart, like how you can like zoom out, how you can identify. Sorry, the supply and demand. Let me open the MT4 so that I can illustrate for you quickly before I can switch back to the presentation. Right. Where am I? Just a minute. I'm opening the MT4.
Oh, okay.
Template with default. Default is blank. Right. Let me share this guy here. All right. Can you see my MT4 chart?
Yep, I can see.
You can see it, right? Right. So this is a week.
The one with the.
This is CAD CHF.
Yes, yeah.
So this is a weekly chart for CAD CHF. Right. So you can clearly see we've got this high here, we've got this high here, and the market is approaching that same
demand zone. Yeah, that's zone. Yeah.
That's a supply zone.
Okay, my bad. Yeah.
That is a supply zone. Demand to the downside,
it's
supply to
the top one.
To the top side.
Top. All right.
Right. So now let me highlight. Let me go there. Insert. So you grab your rectangle tool. Right now, since it's a weekly chart, I'm just going to be highlighting with the rough estimate. Right. So once you've highlighted like the highest points, okay, let me just be specific on this one. You can see this this bearish candle was my point of reference because that's the one with the highest high. You see this one?
Yeah, with the weakest, highest week.
Yeah.
Going into the.
So now.
Zone.
Yeah. Once you've done that, right? So now I'm gonna dive down to the next lower time frame. We are on a weekly chart. I've already highlighted my supply area where I'm gonna be looking to short the market because you can clearly see every time when the market came back to the same zone, it bounces to the downside. Okay? It bounces.
Yes.
So now I'm gonna go to the next lower time frame from the weekly, which is daily. Now let me just zoom out a bit. Right. Now we are on daily. Now you can clearly see the gray shaded area, that's our supply. Now look how market reacted on Friday. We had a strong bullish move to the upside. You see, this is Friday. That's Friday's trading. That means market is heading to the upside. You see, for aggressive traders, some people are gonna short, but now the stop loss is gonna be huge if you short the market where it is currently, and the chances of you getting stopped out will be very high. You see, so now the following week you should be expecting market to test the supply zone, right? Now,
Yes.
once price reaches the gray shaded area, which is our supply zone, that's when you look for
Shorts.
right? Because where it is right now, that's no man's land. You see, because market is gonna spike into your stop loss and takes you out, and then it tumbles to the downside. So your stop loss has to be like big. And now, if you have a big stop loss, that's bad risk management. You're not managing your trade nicely. Because if price continues now into the upward move, eventually your stop loss can get hit and you're gonna lose big time. So being patient enough to wait for the price to hit the supply area reduces your risk for a huge return. Yes, of course, stop loss can get hit, but in this scenario now, we are looking for a high probability trade from this gray shaded area, right? So now,
Yes.
let me go to let me highlight. There's something that I need you see this market has been rallying, right? Can you see market has
Yes,
been rallying?
yeah.
Now there's this bearish candle here, the one on Thursday's trading day, right? That candle is very important when you are trading. Remember, a supply zone, or okay, let's start with the demand zone. A demand zone is created during an uptrend. A supply zone is created during a downtrend. You see, like
Yes.
as in fresh levels of demand, they are created during uptrend, and fresh levels of supply, they are created during a downtrend. So this bearish candle here, let me zoom into it. Let me zoom into it so that you can see clearly. Right. So this bearish candle, you see, that's a demand. That's a demand zone that has been created by price when it was rallying to the upside. This candle, this indecision candle here, that's a demand zone that has been created in the market. So now, when you see price retracing back to this level, expect it to bounce to the upside. We've got a strong uptrend, right?
Okay, yeah.
Obviously, market is not just going to be moving all the way to the upside without any retracements. No, market has to breathe. You see?
Yeah, that's true.
Market has to breathe, and this is a daily candle. So now, once you have highlighted, okay, we've got a new demand area that has been created. You take your rectangle 2, right? You mark the lowest low and the closing price of that same candle. Remember, the lowest low and the closing price. That's for a demand. If it's a supply, it's the highest high and the closing price on the candle. So you can see now my shape, the rectangle 2 that I've used. I've highlighted from the lowest low of that bearish candle to the closing price. I don't mind about the top wick when it's a demand, right? So now we've got 2 levels highlighted. Let me just expand this and change the color. Let me change this color. I put, say, yellow. Yellow is too much. Yellow is too much. Too bright. It's even messing up my eyes now. Right. I've put that magenta color now. on a demand area. So now, what you would expect the market to do is it has to retrace. Yes, market rallied on Friday, but at one point in time, yes, it's gonna rally, but when it comes down here, there's great chances that the market is gonna bounce with the continuation of the strong uptrend. Because these buyers, they're not gonna just be
Uptrend.
yeah. All these buyers here, buyers are in control of this market, right? That's clear. Buyers are in control.
Yes.
Yeah. So they're not gonna be easily taken out. The only way they get taken out, the sellers will come through once we hit the supply area. But when you see market retesting this demand area, then expect it to bounce to the upside. Because right now, there's a lot of liquidity above these highs. As in, a lot of people have got stop losses there, people who are anticipating market to go down. And I expect market to take out those stop losses and comes down before it continues to the upside. You see?
Okay.
Yeah. So this is a daily
Yes.
candle. You see, I've highlighted a supply and a demand. So now let me go to H4. Let me zoom out a bit. I don't know if you're gonna see clearly now.
Yeah, I'll zoom in.
I don't know if you're gonna see clearly. Right. Now this is an H4 chart. You see. Now we are on an H4 chart. I need to highlight the highest high. All right. Now I'm gonna zoom in. I need to see that one there. Right. You see these highs here. 1, 2,
1,
3.
2, 3. Yes.
Right. Look, the highest high of Friday. It just went in. It didn't even close above. Right. It didn't even cleared these highs. Price did not clear them. Right.
It was below. Yeah.
Yeah. So now that in itself, that's a price action telling you that there is liquidity above here. There's a lot of money here. But now market is enticing people to go to the downside. Right? Market is enticing people here. The moment
Yes.
the moment we go to a 30-minute time frame, you're gonna see a huge rejection on this candle. That means market is enticing traders to go short, right? But now it's too early to go short. Yes, market can move to the downside, but if it does move to the downside, then it's this demand area that you look to take the market all the way and clear up this liquidity here. So it means your target is going to be these highs if you are trading from that demand area, this guy here, the magenta color. So if market comes down, yeah, then it's going to go to the upside, and it can move it can even clear up these highs here. You see, it can clear up these highs from, I don't know what time.
Previous. Yeah.
Yeah, that's April. So that's basically how you can identify, say, a supply area or a demand area. You see, like this demand that I've highlighted here, the more you go to a lower time frame, let me jump to a 15 minute. I hope it's going to update. Right. Now we are on a 15 minute. Check that demand that I highlighted. You see, every time the price is bouncing to the upside, it comes down, it bounces to the upside. Look here. You see, it's more.
Yeah, I can see. Yeah.
You see here and here.
Yeah, it's making sense now.
So the moment you see this price coming back to this area, the chances of market bouncing, they're quite high. You see, it's a favorable trend. You see, because from a higher time frame, market is going to the upside. from a higher time frame. CAD CHF is bullish. So the moment you see a retracement into a newly created demand area, then there's a higher chance market is going to bounce to the upside in continuation of the higher time frame bias, which is bullish. You see? So that,
Yes.
yeah. So that in itself, the act of identifying the supply zones or the demand zone is very crucial. It's a thing of whereby a person has to practice. Like once a day, you open any asset, any chart that you think of, and say, okay, no, I just need to highlight demand zones on this pair here and see how many I can highlight. You see, so it's a case of practicing. Yes, me, I'm gonna be there in the group highlighting, like, especially the trades that we are gonna be taking, to say, okay, guys, no, we are gonna be looking at this level. But on your side also, you have to know how to identify the same areas. Let's say, for instance, Ivan is not around. You have to know how to identify your supply zone. You have to know how to identify your demand zone.
Yeah, that's true. I have to put in some work here.
Yeah. So now let me go back to the presentation. You can see the presentation screen, right?
Uh,
The one with how to find the supply and demand on a chart. That's the one I'm sharing now. We are back on our screen notes.
Yeah. I'm back there.
Yeah. So this is a gold, and it's highlighting a strong supply zone. So the moment you highlight a supply zone, especially let's say a supply zone or a demand zone on a weekly chart, the opportunities that you're gonna get there, if you highlight it perfectly, if you identify the supply zone or the demand zone from a weekly time frame, the moment you identify it perfectly, the opportunities that will arise from that, they are quite massive. So that's one of the most important thing that you have to know. You see, so it's a case of knowing. Yeah, it's a case of knowing. Okay, I need to be in a position to what? To identify a proper supply area. I need to be in a position to identify a proper demand area, because these are the areas where price always reacts massively. They don't react like a ranging market. Market does not hang around on a supply zone. It moves away from that zone quickly. And in most cases, institutions, they use fundamentals for the market to react from a supply zone. They use fundamentals. They use fundamentals for markets to react from a demand zone. You see, so it's things that with time, you're gonna understand it. You will exactly know what to do. You see.
Okay. Can I ask a question?
Yes, Cosmos, you can ask.
Since we be trading the higher time frames, sort of on a week on that weekly chart.
Yeah.
How long back do you go? I mean, the weeks or a month to draw your supply and demand zones.
Right. In most cases, it's determined with the asset. Say, for instance, Euro USD, right?
Yes.
In my case, mostly what I do is I go back like all the way to 3-4 years back, if it's from a weekly time frame
perspective.
Yeah.
Okay.
Yeah. So it's the higher you are on an asset, you see, it means you also have to look back from a higher like an old, because there's no need to be looking at data from, say, 2008, 2009. You see, But anytime after that 2008 recession, anytime after that, say from a major's perspective, say USD CAD, USD CHF, gold, you see, anytime after 2010, it can still be relevant on the chart. You see?
Okay.
Because
Right.
there are some levels. Let me see. Where's my MT4? Let me share the MT4 quickly so that you can see what we are talking about. Let's go to gold. I'm gonna go to where's my, let me go to a monthly chart. Right. You see with gold, this is gold, right?
Yes.
Yeah, you can see the weekly chart, right? Now this is a monthly chart of gold.
Yeah.
Yeah, this is a monthly chart. Look how market is reacting from those 20, that's 20 what? 2012 supply area and yeah, and 2011. Let me zoom in. I hope I can be able to fit all of them. Right. Where's my highlighter? Can you see that bearish candle to the extreme left, the one I've highlighted?
Yeah, the 2010, I think, yeah.
Yeah, that's 2010. Market is going to react on this candle. You see? It's going to react. And this is 2013. Yeah, this is 2013. You see these lows are for 2012. Market will react. But now in this case, you can clearly see that it's building up momentum to keep going to the upside. Yeah. So now, the moment these highs are cleared, if market does clear these highs, they become irrelevant in the short term. You see? They become
okay.
Yeah. Unless when market rallies and clears up here. You see here, these highs here. If market clears them up and then it comes back now, then you look to be trading again these highs. You see, once they are cleared. Because there'll be liquidity, because people will take note, you see.
Okay.
Yeah, people will take note, especially retail traders. We are very good at that, in taking note of higher highs, lower lows, higher highs, lower lows. I'm sure you have read that from the order flow document.
Yeah.
As retail traders, we are very good at that, but it's not a good because we get taken out easily, you see. You get taken out easily.
Okay.
So yeah, if it's a major pair or a major commodity, I can even go back as in like 5-6 years back when I'm looking from a higher time frame, say a monthly or a weekly. I can go back. The moment I see that, okay, no, we are testing a level that has never been tested since 2010, market is gonna react. If it's a major, if it's a major asset, the majors. But if those are like some of the exotics and everything, those things, they never react, man. You see?
To just move as they wish.
Yeah, they don't react, because they don't move that much. You see?
Okay.
For majors, let me see. Let me go to Euro USD. Euro USD and gold, they're almost the same. You see? Let me go to a monthly chart. Let me see for it's my 19. You see this? You see, that's a monthly chart. But if you look at the lows that I've highlighted, this one is 2008. Only after, in 2010, that was after 2 years, market reacted. Then in 2012, after 2 years again, market reacted.
Yeah.
You see? And then now, 2018, market reached those, it cleared. You see?
Level again.
And then it reacted to the downside. You see? So on major, a level which hasn't been tested, even if it's like 5-6 years ago, you need to look at what kind of price action will be happening when price reaches that level. So it's not a case of saying it's not gonna react. The data is too old.
It's past.
Yeah,
Okay, yeah.
market always reacts. History repeats itself in markets. But now it's a way of knowing when, knowing when to jump in and when not to jump in. That is the most crucial part, of which in our next lesson, that's what we are gonna be talking about in our next lesson.
That is,
Yeah. So for now, for today, I've managed to highlight to you what is demand. We just went through like the basics, right? How to draw demand. So I'm gonna send you the course notes now, and then you can read through properly. You see. Then when you have questions, don't hesitate to ask, because our time is almost up now. I have to go somewhere now. The missus is waiting.
no, it's cool. No, it's good. Thanks. Yeah.
I'm gonna send you the document, and then you can read through. And then any questions that you've got
through it, yeah.
Don't hesitate to ask. You see, don't hesitate to ask.
Oh.
Yeah. So now.
Okay, so
yeah, I've also sent the mentorship video for the upcoming week, and I've sent the detailed analysis of the pairs that we are going to be looking at. And from what I've already learned from you, you seem to know almost what you're doing there, because I've met some that are like clueless. So you also
I benefited a lot in that WhatsApp.
Yeah.
I mean, I benefited a lot in that WhatsApp group. I was one of the said guys when you closed it. Like, these guys not serious.
You know the reason I closed that group.
Yeah.
There were people who were getting too big-headed for a free thing, you see. So for me, I said to myself, no, man, I don't.
Yeah, I know.
I don't need this. It's best I deal with people that really know what they want to do. But anyway, I'm gonna send you the course notes just now, and then you can just go through.
Oh, okay. Thank you, sir.
All right, Cosmos. Have a great evening.
Okay, enjoy. Thank you.
Bye bye.